Hello. Today I'm going to talk about revenue recognition and expense recognition. These are the two principles that guide what we're doing in Chapter 3, which is adjusting entries. Okay, so the adjusting entries are there to make sure that we follow the rules of revenue recognition and expense recognition. Recognition means, when do we count the revenue? When does the revenue show up in the income statement? Okay, so we're going to go through these couple of exercises to illustrate this. Exercise 3.1, number 1, American Airlines collects cash on June 12th from the sale of a ticket to a customer. The flight occurs on August 16th. Now the question is, which month do you recognize the revenue? Okay, not the cash, the revenue. The revenue recognition principle says you recognize the revenue when it is earned. Okay, now that doesn't mean you don't record collecting the cash in June. When you collect the cash, you debit cash to make it go up, but then you put that same amount in unearned revenue, which is a liability, not a revenue account. Now, why is it a liability? Well, the reason is you've collected cash and now you owe the customer something. You owe them the flight that's going to come in the future, or barring that, you owe them the cash back. Okay, so that's why it is a liability. Then when we get to August, when we have earned the revenue, then we debit the unearned revenue to make it zero and credit the revenue earned that will show up in the income statement in August. Okay, number 2, on March 30th, customer pre-orders 20 Supreme pizzas without onions. Why that's important, I don't know, from Pizza Hut for a birthday party. The pizzas are prepared and delivered on April 2nd. Company receives cash at the time of delivery. Okay, here we have a little different scenario. Yes, they ordered them in March, but no cash changed hands and no services were performed in March. The service was performed, prepared the pizzas, delivered them, and the cash was all received in April. So here we're only going to have one journal entry to record the revenue that is earned in April and the cash that is received. Number 3, actually that was number 3. Number 2, customer purchased sunglasses from Eddie Bauer on January 27th on account. Eddie Bauer receives payment from the customer on February 2nd. Okay, on account means they sold the sunglasses to the customer, but the customer didn't pay yet. Okay, they sold the glasses in January, so they're going to record the sale as a revenue in January. They did not receive cash yet, so they're going to record accounts receivable in January. Then when the cash is received in February, we're going to decrease the accounts receivable and increase the cash. So there we have one asset going up and one asset going down. Number 4, customer pays in advance for a 3-month subscription to Sports Illustrated on July 1. Issues are scheduled for delivery each week from July 1 through September 30th. Okay? When they receive the cash in advance, again, we're going to debit cash to make it go up, credit unearned revenue, liability, and then as the subscriptions are filled, then we're going to record the revenue as it is earned each month. Okay? Exercise 3.2, expense recognition. The expense recognition principle says that we're going to record the expense when it is incurred, no matter when the cash actually moves. So when did the expense happen? Okay, number 1, American Airlines operates a flight from Dallas to Los Angeles on August 16th. the pilot's salaries associated with the flight are paid on September 2nd. Okay? The salaries were earned by the employees in August. The salary expense should be recorded in August. Okay, so we're going to record salary expense, goes up with a debit. Salaries payable, which is a liability saying the company owes this. Then on September 2nd, when it's paid, then we're going to decrease the cash and decrease the unearned or the salaries payable. Okay, number 2, any buyer pays cash on January 6th to purchase sunglasses from a wholesale distributor. The sunglasses are sold on January 27th. Okay, both things happen during January here. So the expense of the sunglasses is going to be recorded in January. Okay, on January 1, Pizza Hut pays for a 1-year property insurance policy with coverage starting immediately. Okay, the insurance was paid in January, so we're going to show the cash going out in January. None of it has expired yet on January 1, so we're going to record prepaid expense. Okay, so we paid the cash, but we haven't gotten anything for it yet. So we've got a prepaid expense, which is also an asset. Then each month as the insurance expires, we're going to expense 1 month worth of the insurance and take it out of the prepaid expense. Number 4, signs an agreement with CBS on January 12th to provide television advertisements during the Super Bowl. Payment is due within 3 weeks after February 4th, the day of the Super Bowl. They make the payment on February 23rd. Again, signing an agreement in January is not something that we record. Nothing has changed hands, no services have been provided. Everything happens in February. So the payment is going to happen in February, and that's when we're going to record the expense. Thank you.